In this video from accounting101.org, we're going to go over creditor's loss treatment and when it will be business bad debt and when it will be non-business bad debt. And this all stems from section 166. If you want to view these videos in order, you can go to our main website at accounting101.org or click the link in the description below this video. So in this diagram right here, section 166, you either have business bad debt, which results in an ordinary loss, or you have non-business bad debt, which results in a short-term capital loss. This is usually to a non-corporate person or an individual investor. So the explanation is when a business or when a corporation goes out of business, what happens is different for a creditor or versus an equity holder. If the creditor is a corporation, the bad debt is usually an ordinary deduction under a business bad debt. But if the creditor is something other than a corporation, such as an individual, then the bad debt can be treated two ways, as an ordinary deduction or as a short-term capital loss. What makes the difference is the type of loan it was. If it was a business bad debt, the investor gets ordinary loss treatment, but if it turns out to be non-business bad debt, then the loss will be given short-term capital loss treatment. Now, whether or not something is business bad debt or non-business bad debt is hard to define, and one of the ways to determine this is whether or not the corporation is in the business of loaning money. If it is, then it will usually just be treated as business bad debt because that's the business they're in. But another thing is, if the person is loaning money to their employer so that the business can continue, or just so that they can continue to receive their salary, those are two different things. If they're trying to just protect their equity stake in the business in general, that's different than if they're loaning money to the business to continue to receive their salary, which is a rare occurrence, as it sounds. So in most cases, an investor is loaning money to a corporation so that the business won't fail, and that will be considered non-business bad debt and will be given short-term capital loss treatment. Now, this isn't ideal for the investor, obviously, since they can only deduct $3,000 a year unless the investor has significant capital gains that the loss can be offset against. Now, one case that kind of deals with this is United States versus Generes, creditor's loss treatment case. So in 1954, Generes formed a construction company. He owned 44% of the stock and was president. He received an annual salary of $12,000. He loaned money to the corporation once in a while, and he acted as a guarantor on several of the corporate loans that he made to the company. In 1962, Generes, or his company, severely underbid two projects. They ended up having to pay the bonding company over $162,000 because he had personally indemnified the bonding company. So Generes loaned the business another $158,000 to keep it alive. The corporation went bankrupt. He was unable to recover his money that he had loaned to the business. On his 1962 tax return, he claimed a non-business bad debt for the $158,000 loan, and he claimed a bad business debt loss for the $162,000 he paid to indemnify the bonding company. So he testified that his sole motive in signing the indemnity agreement was to protect his salary of $12,000 a year, which would have given the $162,000 loss. It would have been classified as business bad debt and given him an ordinary deduction. But the issue came down to what was the real reason for entering into the indemnification agreement and paying the bonding company $162,000. And the court ruled that the dominant reason was what controls the decision, and they deemed the dominant reason to be that Generes was looking to protect his equity, not his salary. So the $162,000 was given short-term capital loss treatment.